hero of the day. Let's start again. Good morning. Okay, thank you. So now we are recording and we're ready to start. Okay, so let's do that. Let's start. Okay, first of all, before we start with what we have to do today, I don't know if you noticed at the bottom of each homework question, there's this little blocky that says, what did I learn from this question? Did you see that? Did you wonder about it? Are you using it? Okay, so basically, this is actually an idea that I got way back when I was writing my psycho exams. The preparation course that we did they gave us this big file full of questions, and then at the end of each question they said, what did I learn from this question? And that is so important, guys. It's not about just rushing through all the homework questions. It's about going through them and making sure that you understand and that you learn something from that question. So please, quality over quantity. Don't try to rush through all the questions just to put a tick next to each of them. Okay, this isn't school accounting. It isn't about working through all the questions, trying to see all the different ways that we can ask you something. Believe me, we are creative. Okay, so we are going to think of new ways to test the content in a way that was not given to you in a homework question. Okay, so please make sure that you, like I said, quality over quantity. Go through a question, work through it. Every time you get something wrong, every time you are unsure about something, I want you to stop and reflect. Stop, collaborate, and listen. Ice is back with the brown. Okay, never mind. Okay, that's way before your time. So stop and think. What is it that you don't understand? Why are you feeling uncertain? Why are you not getting that warm, fuzzy feeling? So and then you put your books away. You actually, you should have a book or a piece of paper where you write that down. Every time when they say, when there's an allowance for expected credit losses, I'm not sure why the tax base is what it is. For example, okay, so stop. Every time you're unsure, put that down, write it down, so that in the end you can come back and say, okay, now I understand this, now I can tick this off. That is so important because you don't know what you don't know. And you have to realize that you don't know what you don't know. So you have to try and put your finger on exactly what it is that you don't know so that you can sort it out. Okay, cool, do you get that? You're going to do that. All your homework questions, we just put this in for IAS 12, this what did I learn from this question? But you have to do that for every homework question that you do. Okay, so don't try and, you can't do summaries for FRK 300. The work is just too much. So therefore you have to just do a summary of the things that you don't know. And then you answer yourself, and then you know, okay, just before a test, you can quickly go through those things. Oh, I must remember, I must do this, and yes, I always forget to do this or whatever, and then you're ready for the test. Good. Okay, very important. Next, just a quick check-in. So from some of the emails that I got, where's Stu? Sorry. Done. Where's Stu? Those are the chats. Can you see the chats over there? Let me share the chats. Okay. Stu is not here. He is watching from home. He has got a little bit of a fever and a dry cough. So he's rather studying from home. Okay, getting distracted. I did take my tablet, so it should kick in any moment now. Okay, so just quickly a check-in. So I've realized that from the emails that I got, the queries that I got, that sometimes some of you might get a little bit confused between the tax base of an asset, the tax base of a liability, versus a deferred tax asset and a deferred tax liability. Okay, so I got a new toy. Let's see if it works. So the tax base of an asset and a liability. Ooh, no, you can't see that. Tax base of an asset and liability. This asset and liability, these amounts come from. No. These amounts come from. They come from the SFP. So these are your SFP assets and liabilities. Okay? Now we get to a deferred tax asset and a deferred tax liability. Now this deferred tax over here, deferred tax asset over here has nothing to do with my asset from on my SFP. So this deferred tax asset here has nothing to do with the asset, the factory building or whatever the asset is that we have on our SFP. This deferred tax asset and deferred tax liability is what we get when we compare our carrying amount of our asset or liability to our tax base, and then we must get these temporary differences, and from there we calculate what our deferred tax is going to be. You get that? Okay, so don't get confused about this. When we talk about a tax base of an asset or a liability, we are talking about how to calculate this amount. So that tells us how to calculate this amount. Whereas the tax base, the deferred tax asset and deferred tax liability over here is what we have in our deferred tax calc. Okay, so just a quick check-in. All happy with that? Okay, so then next. So what we ended up with, what we ended our lecture with when was it? Thursday, is we looked at a deferred tax liability, deferred tax asset, and we looked at the exemption. Okay, remember that? We looked at that exemption, where we said that a deferred tax liability shall be recognized for all taxable temporary differences. So the moment we have a situation, okay, now that is very small, and why is it not showing? Oh, there we go. Okay, so that is quite small, but don't worry. So all I'm saying here is that a deferred tax liability shall be recognized for all taxable temporary differences. So when we compare our carrying amount to our tax base, and it gives us a positive amount. A positive amount is a taxable temporary difference, because our future economic benefits is going to be bigger than the deductions that I'm going to get for in the future. Therefore, I'm going to have to pay more tax in future. So if we have this positive balance over here, then the general rule from paragraph 15 says that for these taxable temporary differences, we will recognize a deferred tax liability. So we will take these amounts and we will multiply them by 28% to get to our deferred tax liability amount. All agreed with that? Happy with that? Warm fuzzy feeling? Warm fuzzy feeling there at home? Okay. Okay. Mr. Shrempel, I see your question. I'll get to that just now. Okay, so that's the general rule. However, now paragraph 15 says that we have there's an exemption. So it says except, so we'll follow the general rule except when, first of all, this deferred tax liability arises from the initial recognition of goodwill. So basically what this just says is if we have a goodwill asset, a carrying amount for goodwill asset, obviously the tax base for that will be zero because we don't pay, we're not going to be able to get any deductions or anything for goodwill in future. So therefore there will be this temporary difference, which is not a real temporary difference because the tax and the accounting will never be the same. Therefore it will be exempt. But we don't have to worry about this now. You'll have a look at that later when we get to group statements. What you have to worry about now is paragraph B, which says that if this deferred tax liability arises from the initial recognition, so first of all, the deferred tax or the temporary difference over here has to arise at initial recognition. That's the first requirement. Second requirement says that the transaction must not be a business combination. And third requirement is that at the time of the transaction, not accounting or a taxable profit, accounting profit or loss or taxable income was affected. And if that's the case, if we can say yes to all three of these requirements, then we will have an exemption. Okay, so there's the exemption. For example, we had it for land. I know that's very small, but so we had it for land where we had a carrying amount, a tax base, and then a taxable temporary difference. But we said, wait a minute, this isn't a real temporary difference because tax and accounting will never, or this land is never going to, we are going to get economic benefits from the land, but we're never going to get deductions, so tax and accounting will never be the same, therefore the exemption applies. Because it arose at initial recognition, first requirement is met, it was not a business combination when we purchased the land, and thirdly, when we did that entry for land originally when we purchased land, it did not affect my accounting profit and it will never affect my taxable profit. So therefore it is exempt. Good. And then we also had a situation for income received in advance, where we said, okay, for income received in advance at initial recognition, when we received the income received in advance would have had a carrying amount. However, the tax base will be zero because the tax base will be income received in advance is the carrying amount less amounts taxable that will not be taxable in future, which is also the carrying amount because everything was taxed in the current year. Therefore, the tax base will be zero, giving us a temporary difference. But now in this case, this is a real temporary difference because for accounting and tax, we are going to be treated the same. Or the accounting and tax treatment is the same, it's just the timing that differs. So now we see if we now apply paragraph B, we say, okay, the initial recognition, the temporary difference arose at initial recognition, so requirement 1 is met. This was not a business combination, so requirement 2 is met. However, when we did that journal originally for income received in advance, we said, so we said debit bank, and then, oh, this is wrong. Okay. Never mind. It did affect that initial recognition. It did affect my taxable profit. Do you agree with that? It did not affect my accounting profit because it was income received in advance. Well, some of that 150 would have affected my accounting profit because some of that was for the current year, but the portion of that was received in advance would not have affected my accounting profit for the current year. However, it would definitely have affected my taxable income over there. So that's why requirement 3 is not met. And then it says, okay, the exemption is not applicable. Therefore, we go back to the general rule that says, okay, take our temporary difference and multiply it with 28%. Okay. Good. So don't worry about the amounts there, just so that you get the picture and how it works. Okay. So then we did the same thing for deferred tax assets. We said the general rule is if we have a carrying amount and we deduct the tax base from that and it gives us a deductible temporary difference, then the general rule says take that deductible temporary difference and multiply it by 28% to give us a deferred tax asset. That's the general rule. However, there's also an exemption here. You'll see further down in paragraph 24, there's an exemption that says unless, and then we get the same situation here. It's just the rule is not there anymore. So the rules are still the same. That the deferred tax asset has to arise at initial recognition. At initial recognition. And then it should not be a business combination. And at the time of the transaction, neither accounting profit or taxable profit should be affected. So there are the 3 requirements. Okay. And you'll see in this little example over here, I could not think of a deductible temporary difference that will be exempt for deferred tax purposes. I couldn't think of an example. If we do, you'll see it in a test. Okay, but we have been thinking about that for quite some time now, a few years, and we couldn't get an example. Good, but that's the principle. So everyone happy with the exemptions? Okay, so before we go on to the limitation, any question on the exemptions? Okay, in the room, no questions. Let's see on the chat. Anyone on the chat have any questions regarding the exemptions? Mr. Schrenkel asked, the tax base is the amount attributed to an asset or liability for tax purposes, whereas deferred tax assets and liabilities arise due to the difference in the accounting and tax treatments of certain items. Exactly. Okay, so you're back with that check in the beginning. Okay, so that's correct. Okay, so everyone's happy with that. Okay, now we move on to the limitation. So you'll see there in paragraph 24 of your standard. Now please, you have to follow me with your standard. So here's my standard. You have to follow me with that. What I suggest that you could do if you wanted to, because it does help to make little notes for yourself in the standard, but remember, then you can't take it into a test with you. So what you can do is you can actually go and download a copy of the all the IAS and IFRS standards from the ISB's website, print it out, and then you make your notes on there. If you want to. Use it, don't use it, whatever you want, but it does help to actually have your little notes in your standard. Okay, even if you have, maybe you've got an old set of books, or you can get an old set of books somewhere. Some of the standards, like for example, IAS 12, did not change. So then you can do like I did, is cut up that book and just, have your standard that you make your little notes in, and then just in your one that you take into the test, you can highlight a flag or whatever the case may be. But please, learn to love your standards. Okay, good students use their standards more than they use their notes. Okay, the notes is just a support. It's just a safety net if there's something that you are unsure about. Okay, so in paragraph 24 of IAS 12, we saw that there was also this limitation. Okay, so we just jumped to the exemption now, but before we get to the exemption, there was a limitation for our deferred tax assets. And it says that we can only take this deductible temporary differences, these deductible temporary differences, and multiply it by 28%. We can only recognize these amounts to the extent that it is probable that there will be taxable profit in the future against which these deductible temporary differences can be utilized. So there's a limitation. So the moment we have a deferred tax asset, we have to remember, ding, 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 warning bells, watch out, there's a limitation that might apply. Okay. Good. So if we, this is just an excerpt of all the information that we used for examples 3 to 5, the deferred tax calculation over there. So I want to show you now the difference between the exemptions and the limitation. So for the exemptions, we looked at specific assets or specific liabilities, whichever might be the case. We looked at specific temporary differences over here, and then we decided whether they should be exempt or not. When it comes to the limitation, what we are worried about is the total here at the bottom. So the limitation applies to our total amount for our deferred tax calculation. Okay. And basically, yeah. Okay, so just note the difference. The exemption applies to specific temporary differences, the exemption, whereas the limitation, we are actually just worried about the total at the end of that calc, which is our closing balance for our deferred tax asset or liability account. Good, so the limitation over here says that we can only recognize to the extent that taxable profit will be available. Okay, so why do you think we need this limitation? Why do you think it's a problem for us if we have a deferred tax asset? So what's going to happen now when we worry about this? When we worry about this is when we get to our total here at the bottom of our deferred tax calc, and we see that it is a debit balance. A debit balance meaning it's an asset. Then the limitation applies. Remember, the limitation only applies for a deferred tax asset. So why do you think that's a problem? Anyone in the room? Yes?
They're just going to keep having negative tax balance no matter what taxing if there's no profit.
Okay, so there will be a negative balance, meaning an asset, a deferred tax asset, and it will just stay there.
If they don't have any profit usually the organization would keep having that asset and then they'll never end up paying tax.
Okay, yes. So let's just also see here on the chat. So Mr. Armstrong says so that it's only different tax account, but if that limitation does not apply. Yes, Mr. Armstrong, you were right. Okay, but the answer to my question, why do we need this limitation, was correctly answered over here. So the thing is, what does an asset on our SFP represent? When we put an asset on our SFP, what are we telling the users of those financial statements? What are we giving them? We are giving them a promise. We are promising to them that there's an asset that has value, that in the future we are going to get the value from this asset. Okay. Now, if we are not going to make, we can only use these future deductions. The only way we can utilize this asset is if we make profits in the future, against which we are going to use these deductible temporary differences and pay less tax. Okay, that's the benefit, that's the promise that this deferred tax asset represents, is in the future we're going to pay less tax. And we can only do that if we are actually going to pay tax in the future. So therefore, exactly like she said, we need to have taxable profits in the future in order for us to use these deferred tax assets. Okay, so that's why we need this limitation. So for example, a while ago, my grandmother, she's turning 90 next month. She came to me and she said, oh, she's very worried. She heard that because she's so old, she doesn't actually have to pay that much tax, and I have to help her to calculate what, or to see if she can't get something back from the receiver. So she gave me all her documents. It wasn't much, it was like a folder. And I went through this and I said, okay, but Oma, you are not paying any tax. Okay, so you are actually already under the, with the additional, what do you call it that you get at the end of the year? Yes, that thing. You are already paying, your income is less than that. So you're not paying any tax. You can't get tax back if you didn't pay any tax. Okay, so that's the same principle here. We can't get these future deductions if we are not going to pay tax against which we can use these future deductions. Okay, so that's why we need this limitation, and that's exactly what paragraph 27 tells us. It tells us that the reversal of these deductible temporary differences in determining the taxable results in deductions determining the taxable profits in future periods. However, if the economic benefits in the form of reductions in tax payments will flow to the entity only if it earns sufficient taxable profits against which these deductions can be offset. Therefore, an entity recognizes deferred tax assets only when it is probable that taxable profits will be available, against which these deductible temporary differences can be utilized. Okay. So that's just what paragraph 27 tells us. Rebates, yes, thank you, Mr. Shreen. Okay, so Ms. Liani there asked us if I can just repeat the reason why we have to have this limitation. The reason is just remember an asset is a promise of future benefits. The benefit of a deferred tax asset is that we are going to pay less tax in future. But if we are just going to make losses in future, we are not going to pay any tax. Therefore, we cannot use the benefits. Okay, so we have to watch out for that. The moment there's a problem that we are not going to make taxable profits in future, then we won't be able to use these deductible future temporary differences. Okay, how do you determine whether taxable profits will be available? You look into your crystal ball that Saika sends you. Okay. So obviously in a question, we will, because you haven't got your crystal balls yet, we will look into our crystal balls in our offices when we send the question, and then we will tell you that we think there will be management thinks there will be taxable profits, or management is worried that there won't be taxable profits in future. Good. So that's the easy thing of being a student. The information is given to you. Out there in practice, sorry for you, you have to make that decision by yourself. Okay, next. Okay, so now paragraph 27 says it's probable. And over here in paragraph 24, here they also said it should be probable that taxable profits should be available. So when is it probable? And here we have paragraph 28 that tells us it is probable that taxable profit will be available against which these deductible temporary differences can be utilized when, first of all, there are sufficient taxable temporary differences relating to the same taxation authority and the same taxable entity which are expected to reverse. So basically what paragraph 28 tells us, let's see if this works. Okay, so paragraph 28 tells us that in our deferred tax calc, temporary differences and deferred tax. If in our deferred tax calc, we have some deferred tax assets over here that we could recognize from our deductible temporary differences. But in the same deferred tax calc, we also have some taxable temporary differences. So paragraph 28 tells us that if these taxable temporary differences are enough to absorb the deductible temporary differences, then we can put these debits into our deferred tax calc. We can include that in our balance. Okay? So that's basically what paragraph 28 tells us. So it says if we have, so the deductible temporary differences will give us our deferred tax debits, and if there are sufficient deferred tax credits in the same calculation, same tax authority, because if we have different tax authorities, we'll have different deferred tax calculations for them, then we can actually, we won't have to worry, we can go and recognize these deferred tax debits in our deferred tax calc. They can be included in that total. Okay, and that's exactly what I said to you before, that we actually only have to worry about this limitation when we get to the total of our deferred tax calc. Okay, so if there will be sufficient taxable temporary differences, if there are sufficient taxable temporary differences in the same deferred tax calc, then yeah, we can just put in those debits. We don't have to worry about that. Okay, so we put it all in. Again, that's exactly what I'm showing you here, I think. Yeah, so we actually only have to worry when we get to a situation where our total deferred tax amount here at the bottom of our deferred tax calc gives us a deferred tax asset. So if it gives us a credit, if we have a positive amount over here, which says we have taxable temporary differences, net taxable temporary differences, we're going to pay more tax in future, we don't have to worry about the limitation, because we are only worried about the limitation when we are promising future value to our users of the financial statements. So that's what paragraph 28 tells us. It says if you have enough debits there, or enough credits there to absorb the debits, if you have a net credit amount like we have over here, don't worry about it. Good. But what about if we do have a debit balance? What if this balance here at the bottom is a debit balance? What does probable then mean? Okay, and here paragraph 29 comes in. So paragraph 29 gives us quite a lot of detail there, but basically all we need to know from paragraph 29 is, first of all, that when there are insufficient taxable temporary differences, so that means we have a net debit, net asset, deferred tax asset, then we'll only recognize this asset if it is, if we will have sufficient taxable profit in the future, or when we have tax planning opportunities available in the future that we can use to utilize those deferred tax assets. Okay, so and that's what I'm going to tell you in the question. I'm going to look into my crystal ball that Saika sent me. It's quite old now. I think I need an updated one. It was like pre-COVID. But anyway, so I'm going to look in my crystal ball. I'm going to tell you, yes, there are sufficient tax planning opportunities available. As we're all going to tell you that we are expecting some taxable profits in the future. So don't worry about it. Go ahead, recognize that deferred tax asset. But most probably I'm not going to do that, because if we limit it, then I can test whether you understand the limitation, and there are some additional interesting disclosure requirements for that. Okay, so most probably, be warned, if you see a debit balance, it is probably going to be limited. Okay, because that just makes it more interesting. Good. Okay. So class example 6 just illustrates exactly this principle that we've now just discussed. So they give us some taxable and deductible temporary differences. And you'll see over here what happens is that, first of all, if we look at paragraph 28, which says if there are enough taxable temporary differences, then go and recognize the deductible temporary differences against it, meaning paragraph 28, remember, said if the net balance is a credit, don't worry about it. Okay. However, in this case, you can see that that's not the case, because if we now add up all these amounts, we get to a net debit. Okay, there are more negative amounts, more debits than we have credits. Good. So that means now paragraph 29 kicks in to say, okay, will we have sufficient taxable profit in the future, or are there tax planning opportunities in future? And if that's the case, then we can go. If that's not the case, then paragraph 24, the limitation. Limitation. Oh, can't see the red. Okay, for those of you in class, we just had some technical difficulties this morning. Hopefully, for the next class, you will only see the PowerPoint, so it will be a little bit bigger. Okay, you guys at home, you can zoom in, do whatever you want. Follow in your notes. You can't see it, can't read it properly. Okay. Yeah, okay, so before we get there. So that's the limitation. Everyone happy with that limitation? Okay, if there's a debit balance that needs to be limited, do we exclude all tax assets from the calculation? That's Mr. Walker asking it on the chat. No, we are not going to exclude them. We keep them there, but what we are going to do now is we are just going to say, okay, so remember now we would have had the situation where, say, our deferred tax had an opening balance, which was a liability. Now we did our deferred tax calc, and we calculate that here at the bottom, we are going to have a debit balance. We actually have a deferred tax asset. Now the problem comes in, what do we do now? Are we allowed to recognize that asset? And if there's now a limitation, then we say no, we're not allowed to recognize a debit, but we're also not going to just take those debits out of the calc and recognize a credit. That also doesn't make sense. So all that's going to happen now is we are going to say this account has to be limited to 0. Okay? So we can't create this debit. We cannot have a debit balance because we are not allowed to recognize an asset. However, we don't take them out of our calc, we keep them there because these are still benefits. So some of those benefits we will be able to recognize against our taxable temporary differences, but we cannot recognize a net debit for deferred tax assets or deferred tax asset net debit. So therefore, our balance will be 0 in our deferred tax account. Okay. What will our journal entry be to get to the 0? Obviously, I hope it's obvious, we are going to have to debit our deferred tax liability account. We're going to debit this account to get to the zero balance with the same amount that we had over here for our opening balance. But what will the contra leg of the journal be? Someone in the room. So nice to have you here that I can pick on you. You can be happy and glad you're not here. Okay, then I can't pick on you. Come on. What will the contra leg of this journal be? The journal will be to debit the deferred tax liability to get the balance to zero. What do we credit? I can hear you thinking it. You're just not saying it out loud. And those of you who are saying, come on. Mr. Shrentel has answered, and Mr. Ngundu, and Mr. Swanepoel, and Mr. Mangari. See, you were also thinking that, am I right? You knew the answer? Oh my word, that's what I hate about accounting students. You know it, you know that you know it, but you are operating from this position of uncertainty. You're not sure, you don't have that confidence that you actually know what you're doing. You don't have that warm fuzzy feeling. If you had that warm fuzzy feeling, you would be going, the income tax expense, I know it's that, it can't be anything else. Okay, so get that warm fuzzy feeling. Okay, yes, so the other leg here will be my income tax expense in my profit or loss, which is, so I will credit that account. Good. I don't understand the difference between paragraph 28 and paragraph 29 in the net deferred tax amount. 29. Apart from difference in the net. So paragraph 28 just tells us that we can go and recognize those debits against the credits. Paragraph 29 just said, okay, but if we now have a net debit amount, then the limitation, then we need to know that there will be taxable profits or there will be tax planning opportunities. Okay, in the future. Okay, so there will be in the future we are going to be making profits. Okay, so remember your deferred tax calc does not, we don't have in our deferred tax, we have future tax consequences of assets and liabilities, but we don't have all the future tax consequences in our deferred tax calc. We don't have our future profits that we are going to make from selling the thingies that we make, the pens that we make or whatever. Okay, so it's just the future tax consequences of the recognized assets and liabilities. Good. Where are we now? What did I want to show you here? Oh, yes, so I just, over here, so I'm jumping to example 8 now. We'll get to example 7 now. I just want to first of all make sure that we get this principle of how the deferred tax calculation works. So what we have here, so this is all the information that comes from examples 3 to 5. What we have over here is the deferred tax calc. And we see here in our deferred tax calculation, our deferred tax SFP general ledger account starts off with a liability of 77280. Now we do our deferred tax calc for the next year, for the X12. So this was X12. Now we do it for X13. And we see that our closing balance should be 82950. So we are now calculating our closing balance. We want this closing balance, which is next year's opening balance, to be 82950. So we'll have 82950 brought down, carried over. I can't remember exactly what. Okay, but for this account now to work, we actually need an entry over here. Do you agree with that? To get to the 82950? And that amount that we put over here, I can't remember what it was now again, that's the amount that goes to my income tax expense in P&L as a debit. So that's the difference, that pink amount. Please, someone calculate it for me, although I can look it up in my notes as well. Oh, no, it's the mask. I know it's the mask. Give me the mask.
How much? 5670.
Cool. 5670. Okay. Which color will work? 5670. Okay. So that's the journal that we need to get to the closing balance. Cool. Okay. So notice here that the entire year, we are not going to touch our deferred tax general ledger account. We are not touching it. It's staying there with the opening balance right throughout the year. Then at the end of the year, we go and do this calculation. We calculate what the closing balance should be, and we fix our opening balance to get to our closing balance. Can you see that? So we don't touch it. Only at the end of the year do we go to it and we calculate what the closing balance should be. Okay. Next week, we will see that there is actually one scenario where we do a journal to our deferred tax calc during the year, the beginning of the year actually. Okay. Otherwise, we leave that. So there will only be an opening balance in that deferred tax account. Then there might be one additional journal that we'll look at next week. I'll keep you in suspense what that is. But that wasn't me, it was the door. Just for in case. I didn't have any lentils for breakfast. Okay, so we'll have the opening balance. We will have one journal. We might have one journal that I'll just tell you about next week. And then we fix the closing balance. Do you get that? Please, this is a very important principle. If we get to a situation where you do a journal for this amount, if you do a journal for your closing balance to income tax expense, I will phone your mother. Because that is wrong, and I'm telling you now that that is wrong. So if you do it, then you didn't listen, and then you need to be, I don't know what your mother does when you're naughty. Your phone will be taken away, or you will not get dinner, whatever the case may be. In my house, you get hung upside down from your feet, from the rafters of the house, for at least 3 hours. During which time you have to say, I should listen to my teacher. I should listen to my teacher. Okay, so watch out. Do not do a journal for this amount. This is the closing balance. Good. Can we move on a lighter note? Okay. So now I've got this little picture here. I want you to stop. Make sure that you understand these basic principles of how the deferred tax calc works before we carry on and we make it more difficult. Not more difficult, more interesting. Okay. Okay, I see some questions on the chat. Ooh, Aina, yes. Can be glad you're not a Kotsa. Okay, so Ms. Swanepoel says, what I meant was, how will there be a net deferred tax asset total and sufficient taxable profits? That's what I said. Remember, our taxable profits in future are not just what we put on our deferred tax calc is the future tax consequences of our assets and liabilities at the end of the current year. But we are still going to have sales and other things, profits next year, against which we are going to use these temporary differences. Okay, so if we think we're going to make profits in future, remember when we do our current tax calc, with our example, we started off saying our accounting income was 470,000 rand. So if we now think for next year, our accounting, we're actually going to have an accounting loss of 300,000 rand. And we are not going to have, when we do our adjustment in our current tax calc, we are going to sit with a current tax loss. Then we think we are not going to have taxable income, therefore we can't use the deferred tax asset. Good. See, Mr. Armstrong has answered. Ms. Natiko there, deferred tax account is a debit balance of from here, then it will be limited to 0 if the limit applies. Okay, cool. Stop said Speed Corp, yes. Stop, let me just translate that. Stop says the speeding head. I don't know, what is Speed Corp in English? A traffic officer, yes. Okay, good. Okay, so warm fuzzy feeling, everyone. Don't defer that warm fuzzy feeling, make sure that you get it. And you cannot put on your cell phone in class. Why are you doing that? Am I not interesting and entertaining enough? Okay, I'm going to show you that I can be interesting and entertaining. Okay, so you're hanging by the feet, watch out. You know my tactics. Good. Okay, so no cell phones, please. This is too interesting. You can't be wasting it on your cell phone. Instagram can wait. Okay, good. Yes, that woke all of us. I'm glad. So even the guys at home are now awake. Okay. Oh, where are we? Yeah. Okay, now to make things a little bit more interesting and to keep everyone off their cell phones, I think I will be doing this section of the lecture cabaret style. Okay, so how do we measure a deferred tax asset? Which rate should we use? This is where paragraph 47 steps in to tell us which rate we should use. Up to now, we just assumed that we should use 28%. But is that always the case? Paragraph 57 says that deferred tax assets and liabilities shall be measured at the tax rates that are expected to apply for the period when the asset is realized or the liability is settled based on the tax rates that have been enacted or substantively enacted by the end of the reporting period. Okay, are we now awake? Okay, can we put that? Can we put? Thank you, thank you. Thank you. Okay. Okay, so we have to use the tax rates that are expected to apply when these deferred tax assets and liabilities will be realized in future. Okay, that's what paragraph 47 tells us. And these rates will be based on the rates that have been enacted or substantively enacted by the end of the reporting period. Okay, so you've heard about enacted and substantively enacted. So now we are just looking at it from a deferred tax perspective. Because paragraph 48 says that sometimes what happens is we will be using oops, silent wasn't mine. Put your phone on silent. Okay. So paragraph 48 says current and deferred tax asset liabilities are usually measured using the tax rate that have been enacted. Enacted means it has been written down as an act, that change in the tax rate. However, sometimes what happens is that the announcement of the tax rate by the government is as good as if it has been enacted. So it has been substantively enacted. Okay, so sometimes it might be that when Master Chef Mweni announces the change in tax rate, that is actually as good as if it has already been written up in tax law. That's what paragraph 48 says. Now we have to think, okay, in South Africa, what is the situation here? And here we have FRG 1, which you can get in your the SICA handbook, that thick SICA handbook that you have that you use for auditing. FRG is it's Financial Reporting Guidance 1. You can use, it's in there, and that's where they tell us that how do we decide? Is the speech by Minister Mboweni, is that as good as if it has already been enacted, or should we wait for the President to sign? So FRG1 tells us that we have to look at whether this announcement of the change is inextricably linked to a change in the tax law. If the answer is no, it's not linked, that means the date of the speech is as good as if it has been enacted. If they are linked, then it means no, sorry, you have to wait until it has been signed by the President. So some pretty pictures to explain that properly. I saw from our current tax section on changes in tax rates that there is still a little bit of uncertainty here. Okay, so if the announcement and the change in the tax law is inextricably linked, it's linked that we cannot make it loose. Okay, it's inextricably linked. The change in the rate and the change in the tax law. Then what we have to do is we have to wait for the enacted date. Okay, so then that change actually only happens when it has been enacted, signed by the President. However, if it is not linked, hallelujah, the change in the tax rate and the change in tax law, if it's not inextricably linked, then we can use the substantively enacted date. Then the date of the announcement is as good as if the President has already signed. Does that make sense? Warm, fuzzy feeling? Okay? So just go and make sure if it is inextricably linked, okay, then we have to wait for when the change in tax law happens. Okay. Otherwise, the date that the announces the change is as good as if it has already been enacted. It's substantively enacted. Happy? Yes, question on the floor. Oh, these masks are horrible. Just try again. Will it not be inextricably linked? When I tell you it's not. Okay. So usually with situations, and usually what happens is when that announcement is made, then like now, Minister Mboweni has announced that the rate is going to change in, what is it, I can't remember from when, but luckily we didn't have to change all our handouts this year. Luckily it's only from next year, or the year after, I can't remember. But anyway, usually the fact that he has announced that, the chances of that not happening are very slim. It's as good as if it has already been enacted. But in a question, we will tell you whether it is inextricably linked or not. Okay, so watch out for that. We'll tell you it is or it isn't, because we make up our own rules for accounting purposes to see if you can apply the rules, the IFRS rules correctly. Okay, because you're not always going to work in a South African environment. None of you are going to immigrate, because you have to stay here to make this a better country for my children and grandchildren. So, but you are going to work with big international companies that operate in other countries as well. Good. Question there on the floor as well, and then there's one on the chat board as well.
Which when are we going to
I'll show you just now. We'll do an example that shows that shows that clearly. Can you give an example of how they might be linked or when they will not be linked? Oh, great, never mind. Cool. Let's move on. Okay, so basically what happens is when we have a change in tax rate, we have to determine three dates. Okay, first rate, the second rate, and the third rate. Okay, or dates. So the first date that we have to determine is, oh, that's not in the nice color. We'll get another color that's easier to see. So the first date that we have to determine is the enacted date or the substantive enacted date. So we have to determine if it is inextricably linked, then we are going to use the enacted date. If it's not inextricably linked, then we can use the substantive enacted date. So when we have a change in tax rate, the first thing that we have to determine is which date is our trigger date for this change. Okay? One of these two. It's going to be one of these two. Second thing is we have to ask ourselves, okay, when will this rate become effective? So that's the second date that we have to determine. When will it become effective? Now, it's obvious that this date, date 2, will always be after date 1. Do you agree with that? Can you see why? A change cannot become effective if it has not been enacted or substantively enacted. Okay? You agree with that? So this date 2 will always happen after date 1. Now the problem that we have, the question that we have is, what we have to determine is this third date is our reporting date. And we have to basically determine where this reporting date falls. Does the reporting date fall after the effective date? Does it fall between these two dates? Or does it maybe fall before these two dates? So these two dates will always, this will always be the first date, this will always be the second date. But for our reporting date, we have to determine, or not first, these two will always be in this sequence. First enacted or substantively enacted, then effective. But we have to determine where does our reporting date fall. Cool. Okay, and that's where we are now going to look at class example 7 in your notes. So class example 7 looks exactly like what we had for class example 1, just completely different, because we are looking and thinking about deferred tax and not current tax. So when we did class example 1, when you watched the video with class example 1, you looked at it, you were probably thinking to yourself, but this is stupid. Obviously, we just think when is the tax rate effective? And if the new tax rate is effective, then we use it. Why do I have to worry about enacted, substantively enacted, and all these other things? And that's correct. For your current tax rate, the only thing you are really worried about is when does it become effective? Because that's when we start using it. But the problem with deferred tax is we are now looking at future tax consequences. So because we're looking at future tax consequences, we have to think about what's the rate going to do in future. Okay. Good. So here they tell us that the rate is currently 29%. Then on the 23rd of Feb, in the budget speech, they announced that it will change to 28%, and that will be effective for years of assessment ending on or after 1 April 20X12. Okay, so we have our effective date over here. We do not yet know what our whether we should use the enacted or the substantively enacted date. So they tell us the date of substantive enactment is the 23rd of February, since the tax rate change is not inextricably linked. It's not linked. We do not have to wait for the president to sign. It is good as if the change has already happened. Okay, so that is then, we're using our substantive enacted date, which is then the 23rd of February. There's our effective date, there's our substantive enacted date. We've got there's our effective date. And now they give us 3 reporting periods. And we have to determine which rates should we use. So the first reporting period they give us is 31 December X11. So now, if we now know what our substantive enacted date is, that is the 23rd of Feb. We know what our effective date is, that is years ending on or after 1 April 20X12. So we see that that is also after our reporting date. Okay. So, first of all, it's logical that our current tax for this year will be our old rate. Do you agree with that? Don't I have it there? Oh, no. Okay, so we'll use our old rate over here. So, so that is the 29%. So for this financial year, for current tax, we'll use our 29%. Which rate will we use for deferred tax? Which rate will we use for deferred tax for this financial year end? 29. Okay, why do you want to use the 29? Yes, because remember, I can't remember the paragraph number now, but it said we should use the rate that has been enacted or substantively enacted at year end. So because this, although deferred tax deals with future tax consequences, because this rate has not been substantively enacted at year end, we can't use it yet. Okay, so therefore for deferred tax, we are also going to use the 29%. Next financial year end, oh yeah, sorry. Remember, if we have this situation, then because we are going to prepare our financial statement somewhere during this time, and during this time we are going to know that this rate has changed, although we can't use it yet because it has not been substantively enacted at year end. We are just going to have an IAS 10 note to warn the users of the financial statements that there has been a change in the tax rate. Good. Next financial year end, 28 February X12. Now we see that our substantive enacted date happened before my reporting period, whereas my effective date happened afterwards. And this is the interesting one. This is most probably the one that you are going to get. Because what happens here is our current tax for this financial year will be calculated using new or old? Old. So current tax will be calculated using the old rate. However, deferred tax, because it has been substantively enacted before the financial reporting date, for deferred tax, we are going to use the new rate. And that makes things just so exciting, because now we have two different rates that we use to calculate our income tax expense for the year. So everyone get this. This, like I said, this is the interesting one. This is the one that we love as lecturers when we set questions. So that's probably one that you're going to get. Although, because I know that you are going to expecting this situation, I might give you this situation. In this situation, what happens here, our reporting date is 30 April X12. So that's the date of the substantive enacted and the effective date. So in this case, for both current and deferred tax, we are going to use the new rate. Okay. So draw your little timelines. A timeline is an accounting student's best friend. Okay, you cannot start a question without at least 3 timelines. Okay, so I see some questions here on the chat board. Do we use the rate applicable at the early of the effective date and the enacted substantive enacted dates? Mr. Armstrong, I'm not sure I understand your question, because for current tax, we are going to look at the effective date. However, for deferred tax, we are not that worried about the effective date. We only worry about the effective date if it happens before my financial reporting period. Otherwise, if it happens afterwards, then for deferred tax, we only actually worried about the substantive enacted date. Okay, the blue doesn't look nice. Moving on. The second situation, can you repeat the second situation? Okay, what happens here is because the effective date is after the reporting period, we will, for our, let me get another pen, let me use green for Mr. Naidu. So for the second situation, because our effective date is after, our current tax will, for this year, will still use the old rate. because the new tax rate is not available yet, or is not effective yet. However, our deferred tax, we are going to use the new rate because it has been substantively enacted before the reporting date. What's the reasoning behind the deferred tax using the new rate? Okay, because in this situation over here, can I clear all this? Clear pen markings, yes. So in this situation that we have over here, because it has been substantively enacted for the reporting date, we know that that is the rate at which our deferred tax assets and liabilities are going to unwind in the future. So that's why for deferred tax, we are going to use the new rate. Whereas, because it's not effective yet, current tax is the old rate. So in other words, current tax uses enacted effective rates. The current tax uses effective rates. And deferred tax uses substantively enacted without it being effective as well. Not necessarily substantive enacted, it might be enacted as well. Remember, in this situation, we could use the substantive enacted date because of the fact that they told us that it's not inextricably linked. Okay, but if they told us that it is inextricably linked, we will have to go and look for the date when the president signed. Is that a good? I think I'll be able to sign off legislation that way. We will have to go and look what is the date that the president signed this change in the tax rate. So in that case, we'll use the enacted date. If it is inextricably linked, that's just answer to that question. Under over provision, with the old rate be used and the new rate is used to calculate the current tax expense for the current year. Yes, because if we have an over and under provision, where's that situation now? If we have an over or under provision for the prior year, and in the current year we are using the new rate for current tax, but obviously in the prior year we used the old rate. So if we have an over or under provision for the prior year, receivers now not going to say, hey, for last year you had an under provision, so now you have to pay us more tax based on the new rate. Okay, so under over provision for the prior year, we'll use the prior year rate. Okay, because that's what I owe them. Okay. Any further questions on the change in tax rate before we look at how we are going to account for that? I think I'm going to lecture, say 3 words, take a sip, say 3 words, take a sip, so that I don't have to put my mask on. No, then I will be fired and my kids will die of hunger. So let me put my mask back on. Good. Okay. Good. Effective change in tax rate. Okay, so what I want you to see here is, first of all, said current tax, we use the applicable rate, which we determined in class example 1. Deferred tax, we use the applicable rate, which we determined now in class example 7. Which means that for my deferred tax movement, there will now be the movement from my opening balance to my closing balance will actually now consist of 2 things. First of all, that balance is going to change because of the change in the tax rate, and that balance is going to change because of my the differences between my carrying amount and my tax base in the current year. Okay, but let me show you an example. So class example 9 uses all the information that we used in class example 3 to 5. The only thing that we changed here for class example 9 is we said, class example 9, we said that we just had a rate of 29% for the prior year that we've now changed to 28% in the current year. Okay. So what happens now is in our T account for deferred tax, in our SFP account, we had an opening balance of 77280. Credit balance, deferred tax liability. Can you see the balance over there? That was our opening balance that we calculated last year. Now what we do is we say, okay, but this balance was calculated using the 29%. So we have to now convert it to what it would have been, because now remember there's now going to be a difference. The movement from here to here, our closing balance, is not just going to be or from the reversal and the rising of temporary differences. Some of that movement is due to the change in the tax rate. So we calculate what is that portion that is due to the change in the tax rate. And to do that, we say, okay, we take the balance, the 77280, we divide it by the 29%, we multiply it by 1% because that's the rate changed 1%. And now because the rate went down, the deferred tax liability will also go down. So that is then what our opening balance would have been if we used the 28% in the prior year as well. Can you see that? Then we go and do our deferred tax calc for the current year, all our assets, liabilities, do all our calculations, calculate what the deferred tax balance should be using the new rate, and we get to the 82950. Now still, in our deferred tax GL account, we don't touch that account. Still, we don't touch that account. All we do is at the end of the year, we say, okay, we want this balance to be 82950. So that's brought down, carried forward, 82950. So the total movement that we want over here, the total movement is 5670. 5678. Okay, never mind. 5670, that's the movement that we want in this account to get to our closing balance. That's the total movement. And we take that to our income tax expense P&L account. 5670. So the journal entry, nothing changes with regard to the journal entry. The journals look exactly the same. So why do we go through this? Why do we bother then to calculate what this amount is, what that amount is due to the change? Okay, you'll see when we do our disclosure that this is an amount that has to be disclosed separately. Okay, so that's why we do that. For our journal, we don't worry about it. We just worry about what's our opening balance, what should our closing balance be, and we do the journal to fix it. However, for disclosure, we are going to have to take this 5670 and split it up between how much is due to the change in the tax rate and how much is due to the reversing of the temporary differences and arising, or reversing and arising. Are you following me? Okay. Okay. Goed. Okay. Okay. Now something else with regard to paragraph or measurement of deferred tax. We find in paragraph 51. So now we know which rate to use. We know what to do when that rate changes. Now paragraph 51 says we should look out for something else. So paragraph 51, IAS 1251 says that the measurement of deferred tax liabilities and deferred tax assets shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amount of the assets or liabilities. Okay, so we've now used the 28%, but is there a situation where the manner in which we expect to recover an asset is actually going to use a different rate from 28%? Can you think of a situation? I see someone here in front is can think of a situation where the rate that we are going to use when we recover an asset in the future is going to be different to 28%. Yeah. So we can either recover an asset. Do I have that here? No. We can recover an asset either through sale or through use. So up to now, we've with our assets, we had our assets on our deferred tax calc, and we said, okay, we're going to use this asset to make pens that we are going to sell at a profit, blah, 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 blah. So we were the whole time thinking about how we are going to use, we're going to use that asset. We're going to recover the carrying amount of that asset through using it, okay? But we can also recover the carrying amount of an asset through sale. And when will the rate be different when we recover an asset? Can you think of a situation? No, Ms. Armstrong, not changing depreciation estimate. That's still through use. All that we are doing is we're just changing the timing of our depreciation, of how we are going to use up that asset. Okay, Ms. Swanepoel hit the nail on the head, and that was what you were thinking of. Well, yes, if we are going to sell an asset in future, and we actually make a capital gain on the sale of that asset, then for the capital gain portion, we are not going to pay tax at 28%. We are going to pay tax at the capital gains tax rate. Okay, so which is 28% times 80%, which I don't know what that answer is. Good. Yes. So if we are, so in our deferred tax calc, we have to, when we calculate what our tax base is going to be, and we calculate what our temporary differences and our deferred tax is, we have to think about what is the tax rate? How am I going to recover this asset in future? Now for FRK 300, we make it easy, because all of our assets we are going to recover through use. The only time that we are going to sell them will be when we have a situation where we do have a revaluation of land. So our land has been revalued to an amount higher than the original cost price. And land, IAS 12 tells us that land can never be recovered through use. You can never use up land. Okay, so land can only be recovered through sale. And if we sell that asset, the land in future, and we sell it at an amount higher than my original cost, so I've had a revaluation of that land at an amount higher, then I have to use my capital gains tax rate. Okay, but we are going to get that in, we're going to look at that when we do IAS 16 lecture next week. Good, but just know that it's not always 28%. But specifically for land, we might also use 28% times 80% to calculate the deferred tax. Good. What else did I want to tell you here? Okay, then 54 and 55 just basically says that we don't discount our deferred tax assets and liabilities. So we know that those guys in the grey suits at ISB, they like to account for things at the fair value. They like to account for assets and liabilities at fair value. But the problem with deferred tax is, you can just think, if we have an asset register for a big company, it will be pages and pages and pages. We can't go and for everyone say, okay, this one is going to be recovered within 1 year, so we don't have to discount it to a present value. This portion 2 years, this portion 3 years. We don't do that. We just leave the deferred tax assets and liabilities as they are. And paragraph 55 says, even if the carrying amount of that asset or liability is at a discounted amount, we still don't discount the deferred tax asset. That's basically for just what 54 and 55 says. Okay, let me just quickly check, where are we now? Okay, so I think that's basically the, oh no, we still have to get to the disclosure. Good, so 9:30, 10:30, so we're almost done. 8 minutes left, am I right? Yes. Okay, so class example 10, I'm not going to do class example 10. Class example 10 just illustrates that principle that we've done since lecture 2, is how these temporary differences arise from 1 year to the other, and then in the end they go to 0. So our deferred tax asset arises and then it goes down again until it gets to 0 at the end, because our tax and our accounting is the same. So go and look at class example 10, but it's similar to what we did in lecture 2. Okay, what I want to show you is presentation first of all. So with presentation, that's on the face of the financial statements. We have the same principle that we had for current tax. Paragraph 57 just says that when the transaction happens in P&L, then the tax, the deferred tax, will also be recognized in P&L. However, if the transaction happens in OCI, like we will have next week when we start doing reevaluations of land, then the deferred tax consequences will also be recognized in OCI. So then what happens is, instead of that movement for the revaluation in the deferred tax balance won't go to income tax expense in P&L, that portion will actually go to my OCI. But we'll look at that next week. So just know that the tax follows the transaction. Okay, and then offsetting, the same rules apply than what we had for current tax. When we have a legal right to offset, and it's the same tax authority, then we can offset our assets and deferred tax assets and liabilities, which we are in any way doing in our deferred tax calc. However, we cannot do that for in a group if we have consolidated financial statements, because then we have different entities. So what's going to happen if we have, you'll see when we get to consolidations, you can actually have a situation where you, on your consolidated SFP, have a deferred tax asset and a deferred tax liability. But in our separate financial statements, we will only have one of the two. Cool. Okay, so we've spoken about this. Presentation. Oh yeah, so remember, okay, let me just make sure everyone gets this. In, what was it, lecture 2, there was a typo on my slides. I put my deferred tax asset and liabilities under current assets and liabilities. That should be non-current. So you'll see it over here. There's my non-current assets, deferred tax if it has a debit balance, non-current liabilities, deferred tax if it has a credit balance. Okay, so there was a typo, but it is now fixed. Okay, 5 minutes left. You can quickly look at the notes, but I want you to be awake and following me when we look at the notes. Okay, you can go and look at it at the video again to make sure you get this and you're comfortable with this, but make sure you understand what we are doing for disclosure. Good, so first of all, the notes that we have to prepare for deferred tax will affect, first of all, in the splocky note for my income tax expense. So there we are going to have the movement in my deferred tax is going to go to my income tax expense note. And we are also going to have a deferred tax note for my SFP balance. Good. Now, before we get to the splocky note, let's first do our SFP note, because that's the easiest one. So the SFP note, basically what we are doing with the SFP note, here's our note. So this is our note. What we are doing with this note is we are just summarizing all the amounts that we have in our deferred tax calc that make up this balance. So all the items that we have over here, where we have a situation where there's a difference between my depreciation and amortization and tax allowances. So that's these two amounts, although I think yeah. So we'll split it up. We'll just say, okay, we've got a part of our balance for deferred tax is due to the difference between tax allowance or my tax base and my carrying amount of factory machinery. So it's a difference between wear and tear for tax purposes that's going quicker than my depreciation. So there's that total. There's a difference, the allowance for expected credit losses. So can you see we are just summarizing whatever these totals are that we have in our deferred tax calc that make up my closing balance, and we're putting that in our SFP note. That's the easy one. Just summarizing the balance. Okay. Now my deferred tax, okay, there's the note, never mind. Okay, there's some additional disclosure there at the bottom that just has to do with when we have the situation where we have the limitation. Then there's some additional disclosure if there's an amount that we have to add to limit. Okay, but we'll look at that in more detail when we do tax losses. Now, what I want to show you with regard to my P&L note, this is the interesting and exciting one that I promise you you're going to see in a test or an exam somewhere during this year, because we love asking this. First of all, part one, I've told you that we have a part one of this note that you know about. And here you'll see for deferred tax, there's our movement from our opening to closing balance, this amount. And there's our effect of our rate change adjustment. Remember, I told you for the journal, we don't have to worry about splitting it between the rate change and the other movement. However, for disclosure, we have to. Are you following me? Everyone following me? You have to be awake. Maybe I should sing again to make sure you were awake. Okay, that's part one. Now look at part two. Wow, that looks exciting. Part two of the note, which is the part of the note that you have not seen before. Doesn't that look interesting? Okay, lots of different things that can go into that note, into that section of the note. Okay, so I warn you now that this section, this part two of the income tax expense note, gives students a bad feeling in their tummies. Okay, don't let that happen to you. Change that bad feeling to a good feeling so that you understand what is happening. Okay, so basically all that section of the note is, if we go back to this journal or this slide that we had in lecture 2. Now you must follow me. In lecture 2, we had a current tax calculation. And in this current tax calculation, we had some differences between depreciation and wear and tear. And in the end, the accounting effect and the tax effect will be the same. So therefore, we call these the temporary differences. And effectively, these temporary differences lowered my taxable income from what it was in my accounting profit, and it gave me a lower current tax expense. But then we did our deferred tax calc, where we compared our carrying amount to our tax base, giving us a taxable temporary difference and a deferred tax liability of 8,400. We did a journal where we debited the income tax expense, credited deferred tax Sfp to create that deferred tax liability, and then the other leg went to my income tax expense note. Okay, income tax expense Sfp account. So effectively what happened was that these temporary differences over here lowered my income tax expense, but then we said, it's not really a benefit because it's going to swing around in the future. So with this journal, we increased it again, okay, to net out the effect of these temporary differences. Good. However, you could see here for the dividend income and the fines, we didn't do anything. We didn't account for that in our deferred tax calc. No extra journals or anything like that, because these are not temporary differences. They are real permanent differences. So therefore, when we did our calc and we said, okay, tax on the accounting profit is not the same as our actual income tax expense that we have over here. If we just take 28% multiplied by our accounting profit, these amounts are not the same. We said, okay, why is that? And the reason for that is because of these non-temporary differences that we could not fix. You agree with that? Can you see that? The dividend income and the fines over here are the non-temporary differences that we could not fix. The temporary differences we fixed over here. The decrease in our current tax calc, we increased it again to say, wait a minute, it's going to swing around later in the future. So we cancelled out these temporary differences. But we couldn't do anything with for my non-temporary differences. And that is why we have this difference, because of these non-temporary differences. Happy with that? Warm, fuzzy feeling? Cool, because that warm, fuzzy feeling means that you actually understand part 2 of our income tax expense note. That's all it is. So part 2 of that income tax expense note, it looks very complicated, but basically all it is it says, these are the things that we could not account for with deferred tax. These are the things that we could not fix with deferred tax. Okay, got that. Okay, then I am going to, okay, so that's just the note. It looks very complicated, but it's not that bad. Then I am going to stop here. You can go and have a look at class example 11. It's a nice long example. It takes it from my current tax calculation straight through to my, my disclosure in my notes and my presentation. So go and have a look at that example along with the homework that you have to do for today. Okay. Now, all the questions that you should be able to do today, but like I said, quality over quantity. Even if you, for now, just focus on every second question that we have over here. Even if you just do that, make sure that you do it and you do it properly. Okay. So that's it. Then thank you for joining me in class. That was so much fun. And thank you guys for joining me from home. Please press the like button at the bottom and subscribe to my channel. Okay, and tell your friends about it. And I'll see you again then on Thursday. Okay. Good. I'm going to stop the recording.